It's great to be in Madrid. Thank you for joining me. Let's see. First off, I like Spain because it's always sunny, like where I live in Phoenix. So, I used to live in Seattle. It was always depressing and dark, kind of like London. I apologize for my colleague who's got to live out of there, but I live in a beautiful country like this. So I'm going to talk about U-Haul today. There was a couple things the prior speaker just mentioned. I'm going to hit on those because I'm going to plagiarize, because there's good ideas, and I'm going to expand on them. So, really quickly about us, we run about 5.5 billion US dollars, predominantly in a US equity strategy. We also run an ex-US strategy. Like was mentioned, we're based in Phoenix, Arizona. I have a colleague in London. We also have an office in Jersey City. We started our company back in July of 2007. We didn't die during the prior value era because we did well, and so this is just a fun world to live in now that people have figured out it's stupid to overpay for things. So here's our team. Dad and I are the PMs. We have 3 analysts. I'm not going to spend much time there. So here's kind of our agenda for what I'll talk about. We're going to look at Americo, which is also referred to as U-Haul. And we'll talk about, if you're not familiar with the company, a couple people mentioned to me yesterday, oh, that's the rental car or rental fleet company I always see when people are moving goods around in American movies. And the answer is yes. It's a white truck with a beautiful orange logo. It might as well be creamsicle orange. It's part of Americana, if you will. Someone asked me, do they put those vehicles in those movies as product placement? And the answer is no. They're the only game in town. People use that brand in the movie because they know it looks American. And so I will talk today about why U-Haul, as a $10 billion company, is really an American blue chip company. And we'll talk about its history, we'll talk about its owners, and things of that nature. So here's our 8 criteria. I'm going to use this to walk through U-Haul. I'm giving you a little more. We did actually our recent quarterly webcast with our investors on U-Haul, but I'm actually adding a little more because I want to give you a little more meat to kind of cogitate on. So first off, meets an economic need. What I would argue to anyone is this is the most successful consumer logistics business in North America. What do I mean by that? There's 3 parts to U-Haul's business. One is those trucks. It's those trucks, those trailers, those moving vans. That's what people use to move. When I say consumers, these are not business-to-business transactions. This is where Joe Sixpack in America wakes up and says, I'm buying a couch. I need to get a truck to go move it. So he rents the truck for a day. Or as you see people leaving Los Angeles because it sucks to live in California, and it does. They get a U-Haul, and they drive it across the desert, and they stop in places like Yuma for gas, and they show up in Phoenix, Arizona, and say, thank God, I'm free, okay? So that's a big part of their business. The second part of their business is the storage business, and I'm going to teach you some of the economics of the storage business. I'm going to teach you why the storage business is there. Ultimately, why would you put a fleet equipment rental company together with a storage business? Because the really nice lady or gentleman that rents out the truck will also rent you a storage locker to keep your stuff in when you get it to your location. In other words, we're running higher returns on capital with the same cost, okay? Because when they're not doing anything, it's just one person sitting there. It's not 2. Lastly, and I won't talk at all about this, but I'll just throw this out to you. There's a little mini Berkshire-like aspect of U-Haul. They own a life insurance company. And this life insurance company was actually created out of the randomness of 1960s tax law, where there was a tax benefit for providing life insurance to the employees of U-Haul. And that's not there anymore, but they still have this life insurance company. I'll teach you a little bit about what they do with that because there is a cost to capital benefit they have to that. But that's the 3 parts of their business. So here's a look at what I consider their strong competitive advantage. We look at locations here. They have about 2,200 company-owned locations. You can see here on the colors, that's where they sit in the map. They have little locations in Canada. It's really a U.S. business. They have nothing in Mexico. So this is their company-owned locations. This, you see all this blue? That is their company plus the affiliates, okay? They absolutely dominate this market in America. People often ask me, well, Cole, who's number 2? Like, who's the number 2 out there? And what I love is nobody knows. It's like, how tough can your business be when nobody knows your competitor? Just so you guys are aware, it's Penske, okay? Penske is the number 2 in the market, and no one knows who Penske is because they don't think of an orange truck, like I pointed out earlier. As you can see, a little interesting statistic, they can reach 90% of the US population within 5 miles of a location. Okay, so they have a huge advantage in terms of their installed base, their brand awareness, and we'll talk more about this as it plays into the storage business. So really what their moat is as a business, like what's their competitive advantage, beyond that location, it's their ability to invest, okay? So if I go to people and say, hey, here's the deal, you have this fleet equipment business. You have to maintain that. Nobody's going to be like, great, I want to go spend hundreds of millions of dollars on trucks and replacing those, and that's very unsexy. I'm 39. That's not what people go to college for. Okay, that's not what you get a computer science degree for. So there's nothing attractive about this business from an optical perspective. But then secondly, we break out, you'll see the various forms of CapEx, and this little black line is their net amount of CapEx they spend on their fleet. But the big orange lines you're seeing there is what they spend on their storage business. And we're going to talk a lot about this because this is a big deal. But you'll see that their largest amount of CapEx they're going into is their storage business. But again, how many companies can go out and spend $500 million or $1 billion on capital-heavy projects like this and have a lot of know-how? We just can't find that out there. Okay, long history of profitability and strong operating metrics is our next criteria. So we're overarchingly, what we're trying to find is a company that produces really high returns on capital, and if we can get that increasing, even better. So I lay out various margins of this, but the most important one I want to pay attention to is what they've done with their return on equity looking back over this time period, okay? They've increased margins. They've increased the return on equity. I'm going to teach you a little more of the why of that, because originally this business was just the fleet rental company. It was created by a couple who drove from Los Angeles, California up to Ridgefield, Washington, near Portland, Oregon. And that couple was like, gosh, that sucked. We had our kids in the back. We need more space. And so they created the trailer business out of that. Well, that's really what the history of the business has been up to this point. But the reason why the return on equity is climbing is because they've been adding that storage business as the second component, okay? And we'll dig more into that. But again, you can see they're doing something right over time, okay? And I'll teach you more about who that person or that family is, okay? Generates high levels of free cash flow. I love this. The quant gets this wrong, okay? The quant gets this wrong. So everyone's like got their little like spreadsheets they're running all the time on companies, and they're like, oh, we hit like 7 of these and we can start talking and whatnot. Well, I love this because if someone goes into their Bloomberg terminal and says, hey, does U-Haul produce high levels of free cash flow? Well, as you can see here, no, it doesn't look like it. Huh, pass. They're gone. The quant spreadsheet moves on. Okay, but that is not looking at the business, thinking about the business, thinking about the business as though you're an owner. Why are they running negative free cash flow? Well, if we go back to the CapEx slide, where are they spending most of their CapEx? They're spending their CapEx on growing the business, okay? Some people call this the willingness to suffer. In other words, you're willingly giving up on more cash in your back pocket today. It is 1 in the hand versus 2 in the bush, okay? And they are practicing that. Now, further, why would the quant miss this and why would Wall Street miss this? Because there's no analysts that cover the stock, okay? There's not a single Wall Street analyst that covers the stock. So what we find really interesting is we can have a very strong understanding of the business. This is not some micro cap, small cap. It's a $10 billion company and growing, okay? I'll teach you why Wall Street doesn't cover it. But again, they're producing free cash flow, but they're choosing to reinvest large parts of that into growing their storage business. So low price in relation to its intrinsic value, I'm going to throw out, here's looking back at their book multiples. Now, why am I using their book multiples? Why am I not being like a classic value person and saying, oh, look at the PE, it's wicked cheap, and that's super cool, and go value? Because it's just not that interesting, and it's not really what drives their business. Remember, I said they're making large CapEx investments. Well, CapEx ends up on your balance sheet. But if the investment doesn't mature right away, you're not producing much in income. So therefore, it's a pretty poor way to look at a business like this that's putting out large CapEx to grow their business. Okay, now, here's what I think people should be paying attention to, okay? If you look at book value per share, in fact, if you go back, Berkshire Hathaway showed book value per share. They did that for many, many, many years. They compared that against the S&P 500. And you'll notice even Berkshire Hathaway has quit comparing that. I think it's a very helpful tool when you're looking at businesses in general, particularly businesses that just don't trade at extreme book multiples, because they're going to tend to track their book value per share, even if they're buying back stock at a premium to book. And so here's a look at what Americo has done looking back. This is over the last 10 years in their book value per share. Okay, they've grown book value per share. I think the number is, let's see. Yeah, they've grown about 20%. Okay. Now, I'm going to show you the next slide because it's kind of the fun part. It's where the value creation goes. Okay, here's a look at what the stock's done during that same time period. So isn't it interesting? They've grown book value per share by 20%. What's the stock done? 18. It's roughly tracking the book value per share growth of the company. I mean, this is not rocket science. Okay, but now I'm going to go one step further on this, because just so you're aware, when you do all that CapEx in a storage business, again, it takes about 5 to 6 years for a storage asset to mature. And so no one covers this, and people are watching them make these big outlays. And usually the biggest question this company gets is, why are you not a REIT? Why are you not public storage? Why don't you sit in a REIT structure with that part of your assets? We don't think that's important. That's a classic, like, oh, let's restructure this and it looks sexier to someone, we can sell it off at a better price. We really like this business for what it is, for what they do well. And here's just kind of a picture. I'm not going to go into this a lot, but we put this together just to, I didn't give this in my last presentation, but I want to add this, okay? What we did is we looked and said, okay, let's look over the last 4 to 5 years of real estate investments they've made, that big CapEx number on real estate investments, okay? And say, let's put out what they're likely to go to in occupancy in those assets, and let's effectively build in a number of what they're likely to make at maturity. Let's say we did no investments in 23, 24, 25, and we just let these investments mature. Where would we go to in return on equity of the company? They would make about $140 million more as a business if those just were in maturity right now. And therefore, we wouldn't be driving an 18% compounded book value per share growth. They would be taking their return on equity closer to something like 20%. Okay, so right now in the public market, people don't understand what they're doing. They don't understand why they're investing for this. But someone that is thinking about their business like the business owner would be saying, gosh, you know what? If this works well, like they've historically had a track record doing, they'll wake up with a higher return on equity. Now, one other thing. This is a scale business. Why do I say it's a scale business? Look at public storage. Public storage has scale. The larger the scale gets, the returns on capital tend to grow in the storage business. What I also find really interesting is, have you guys been paying attention to what public storage is doing? They're trying to take another company in an unsolicited offer out. So there's a war game going on right now between 2 or 3 publicly traded REITs that have similar assets to U-Haul's storage business. And none of the analysts on Wall Street are getting excited about what these guys are doing in their CapEx to grow their book value per share. Okay, and these are some of the numbers behind it. One thing, if you go look here on the bottom, this is, we show the leverage that the other REITs tend to show. So one of the other components, once these mature, they will add liquidity to the company's balance sheet because they would probably lever them about 30%. That's pretty common in the storage business, is 30% leverage on individual assets, okay? Here's their balance sheet. This is looking out over the maturity structure as we look forward. This goes all the way to 2038, okay? Their free cash flow is roughly about $1 billion. They have no maturities anywhere near that. And again, like I said, they're growing their income. So this is a very well managed balance sheet. I'll go further. Here's the secret. This is the secret, okay? The gentleman prior said, you know, family-owned businesses. This has been owned by the Schoen family ever since its founding. Now, families have problems, as we all know, okay? And so did this family. This family went through one of the most tumultuous corporate fights I've ever seen in my life. Joe Schoen, who is the largest shareholder, it's called Willow Creek Holdings is his company's name, that owns this. He literally wrested control of the company from his own family, including his own father. Okay, now, did that change the success of the business? And the answer is no. These are great stewards. These are great capital allocators. Maybe dad had a problem. I don't know. I don't really care. The public stock market gives you to buy this. And as you can see, they own very large amounts of stock. So ultimately, I would argue to anyone that insider ownership, preferably with recent purchases, which is one of our criteria, is the interaction effect between the value premium and what Cliff Asness argues is QMJ, or quality minus junk, the quality premium. okay? Now, why do I say that? Joe has not only been a big owner, he's been a big buyer here in the last year, okay? Now, when someone buys in the open market, when they already have a lot of their net worth tied up in it, they're not telling you that just it's cheap, okay? That's one of the things they're telling you. And that's what we think about. Often people are like, oh, insider buying, it tells you the stock's cheap. Well, that's part of it. But has anyone ever seen someone buy a company that they think will go out of business in the next 2 years? No, you'd be stupid to do that, which means it tells you something about the capital structure too, okay? We don't hear people talk about that. They'll talk about insider buying in light of what it says about price, but we think it says something different about the quality too. So that's Americo and our 8 criteria. Okay, now let me add a couple of things because, again, you're just running this business for the first time. I want to teach you some things, and I'll mention a couple of things to you that probably no one's told you, but I'll be the American. So this is Federal Reserve Bank of Atlanta data looking at the income quintiles of America, okay? I want to share a couple of things with you that should give you incredible optimism for the economy of the United States because, like I said, this is a consumer logistics business. They deal with consumers. They deal with households. They don't deal with business. If you look at these, the first quartile is the poorest people in America, and the fourth quartile is the highest incomes in America. And what no one is saying, I don't read this in the FT or the Wall Street Journal or the New York Times or any reputable publication, no one is saying that poor people are killing it in America. They're doing incredibly well. In fact, it's the only place in America where people are seeing real wage gains. That's not what the politicians tell us. They tell us that the poor, they just do terrible and it sucks to be them and that's why they get elected. That's what Elizabeth Warren runs on and Bernie Sanders and other politicians here too. But the reality situation is this is not distinct to the United States, but in the Western world right now, we don't have enough people. So the scarcity of labor is driving the price of the cheapest form of labor higher. How bad can your economy be when your poorest people are doing well? Our safety nets are made to catch them. There's no catching needed. I'll go further. Since the beginning of the pandemic, if you look at income quintiles and you can look at their household net worth, you'll find that the poorest people have seen the largest net worth gains. It's crazy, isn't it? By the way, rich people are poor in real terms since the beginning of the pandemic. Okay, think about that. No one's saying that, okay? So I say that because I just want you to understand how strong the environment is around this business. We don't think people really understand that when people of lower means, which are the kind of U-Haul customers we're talking about, they're the people that don't pay someone else to box their stuff up and put it in a truck and ship it. I do that. I'm wealthy. They're not. But then again, people like me are not the best customers because we're not growing our incomes and our net worth isn't growing. That's what these people have, is much better customers. Here's the debt service ratio of the American consumer. Crazy. And they think we're going to have a lot of economic problems because the Fed. This is interesting. Now, I'm going to show you one other thing. Do we have to have a growth market to make a lot of money in U-Haul? And the answer is no. This dotted line right here, that is the percentage of Americans that move every year. This comes off Census Bureau data. And this goes back to like a long time ago, okay? And what happens every year? Fewer and fewer and fewer percentage of Americans move each year. And yet, this stock has compounded wealth unbelievably, okay? So this is not some, oh gosh, we gotta have some ebullient market, we gotta have a great growth prospect, we gotta have this family doing all the right things. No, these guys know how to deal with a declining market. Now, percentage-wise, doesn't mean the numbers nominally are growing, but the percentage of people that in the economy are doing it is declining. And yet that hasn't inhibited the business whatsoever. Let's see. Oh, just the last thing. If you like reading, I like reading. We run a podcast. We interview 2 authors a month. We have some fun with that. If you got any good book recommendations, come find me. Here's our U.S. strategy. Here's our international. And let's go to some questions. So
yeah.
I'll open it up.
Any questions? Yes, concerning, let's say, the real estate market, and because this is very much related to moving activity.
Yeah.
And if there would be, let's say, a prolonged silent period with the, let's say, people moving houses, in a way, how would this company survive that kind of a 1 or 2 year period?
Yeah, it's a good question. Well, so 2 things. I just told you there's really all these cool things around these real estate assets. If you said, hey, Cole, what do you think about real estate in general? in America, it looks terrible. It looks bad, okay? I mean, I think about it like this. If the Fed's gonna give me 5%, what you have to give me in real estate cap rates has gotta be incredible right now, okay? And if I can show you another chart, cap rates are just ridiculously low. So to your point about moving, I'd say two things to that. One, when people are looking at the cost of capital rising, they're not thinking about the amount of built up equity in the system either. Okay, I'll give you some numbers, and just so you guys know, we own U.S. home builders, so I love this question. 38% of homes in America are owned free and clear without a mortgage. 38%. So, quick quiz, when the Fed goes from low rates to 5%, how does that affect those people's lives? On their home, it doesn't. Now, if they have other borrowings, it could affect them, but not on their home. I'll give you another little statistic. If you look at people who do have mortgage, 85% of them are locked at 4% or less. Now, in Europe, or I'll use the UK for example, variable products very common. In America, variable products very uncommon. Okay, so I think one of the things that people thought is Fed will raise rates. To your point, there will be a big trouble in the housing market, and that has not manifested itself because we have low supply of houses. And then secondly, the rise in rates doesn't affect the mortgage. Now, when it comes to the movement, I'm not really worried about movement because most people don't know this, but the largest demographic in the United States is born between 1980 and 2000. It's the largest consumer, and it's still a marginal home buyer, okay? There's still a ton of millennials that don't own a house yet. That's the best market, I would say, for U-Haul is young people buying their first house at the age of 30, okay? Do I expect a baby boomer to go out and do a big move themselves at the age of 65? No. There's a physical issue with that. It's just tough to move when you're older. So I think of their best market being like 55 and down, and we think there's huge fodder for that. Where do I see the biggest movement going? It's migration around the country, not in town. So I think we're seeing there's been a big move away from New York, from LA, that will continue. One question people often ask us is, how do they get the equipment to where it needs to be? It's a market price system. So how do you get a truck that goes from LA to Phoenix and they charge them like $1,400 one way? How do you get it back to LA? You go to the person that needs to go from Phoenix to LA and you say, hey, we'll rent it out to you for $100. And they drive it back. So it's really strange that they can use market prices and consumers to effectively move their equipment. They've tested over the years, can we relocate it ourselves? And they found that they lose money or at best break even trying to move the equipment themselves. So you think about like an eBay kind of company where the marketplace is out there and people create these goods and people find themselves. U-Haul doesn't have to go and say, hey, you should move to Florida today. The consumer says, hey, I need to go somewhere. And they move the equipment for them. Okay, so there hasn't been a deterioration in movement in rental equipment in effect. When the pandemic started, there was a big downtick in people using rental equipment because they were all trapped at their house, and then immediately there was a huge boom. They actually saw kind of a peak run up in Q2, Q3, Q4 of 20, which quieted down, but there hasn't been some cyclical trough off of the higher rates that have come. So.
Massimo.
How long have you been owning this stock?
Yeah, that's a good question. So we bought it in the pandemic, right? When no one could see anything and everyone thought that we were going to be trapped at home forever because, we're all going to be on Zoom calls till we died. And that didn't end up being true. Very randomly, people always ask us, like, how do you get ideas? Well, insider buying is one of the biggest ways that we flag companies, take a look at them, et cetera. A friend at the time, we had relocated from Seattle to Phoenix, Arizona in July of 20, and a friend in that spring had said, oh, hey, have you ever taken a look at U-Haul? Well, oddly enough, they're based in Phoenix, Arizona. We've never met their investment or their management team. I've met the IR person randomly one day. So the idea that we have to know these managers, play poker with them, we don't agree with that. There's a lot of information on these companies. So the circumstances came about. We looked and said, well, we think we're actually at that time we were paying for their fleet. Is what we think we were getting in the stock price. So that's when we got involved in the business. It's a great business. Joe was just buying in the open market late last year. Funny enough, like we added to our position right around then, and we turned around and said, hey, we were fighting Joe for stock. So as they're increasing their stock, it gives us huge confidence in what they're doing, about how they're going to grow that return on equity. And like I said, watching Wall Street fondle over these other REITs in the storage space and not say, oh, by the way, there's a company we don't even cover that has decades of track record and history in this and actually can produce higher returns with that share of expense in the labor. That's really surprising. But when you have a 54% owner, you can't do that much trading. Okay, so it's not very good for Wall Street. That's why they can't sell it. So.
Malika?
Hi. Could you say a little bit more about their storage business? Is there a stickiness factor there because they're using that? And how does that compare to Shurgard and their competitors?
Yeah, the storage business in general is a very good business. So I'm not saying that there's attributes about their storage business that are unique to them. Here's what I would generally say to you. Okay, if you ever watch Silence of the Lambs, okay, which is a grim movie, I'm sorry, but there's a great line from the movie where they're trying to figure out what the serial killer does. And the line in the movie is, they covet what they see. In other words, it was someone living local. That's who the serial killer was. They coveted what they see. Congratulations, I just explained to you the American consumer. They covet what they see. Now, by the way, that's not just exclusive to Americans. That's most humans. But the history of the storage business is people put stuff in storage and they hate to move it out. It's a pain. Because again, it requires frictional costs. You have to go, get a truck, do something, and you have to move all that equipment out. I don't know if you guys have ever seen the TV show Storage Wars, okay? It is not uncommon for people to pay stuff for years and years and years, and then someone dies and it's forgotten, and they don't know how to go next to kin, and so it gets sold off. Wonderful income stream. God bless them, okay? I mean, if you want to understand the immensity of what's happened in this industry, go look at Public Storage's track record. I mean, it's been a great business. What you have to pay for those publicly traded REITs in a stupidly priced REIT world of the last 2 to 3 years, I don't think is attractive, which is why I think they're also trying to consolidate, because they're trying to improve their returns in a world where the cap rate's getting worse, okay? So again, to your question, I would say there's nothing unique to them other than just the fact that they're able to go out and do this, and people aren't attractively pricing the assets like the others are. So, other questions?
So following up on that, I'm wondering, what is the return on capital in storage compared to the moving business?
Yeah. When we're thinking about like how did they get to 18% and how are they effectively moving that to 20% right now, it's because storage is becoming so much bigger. In other words, the return on capital of the storage business, I'd say, is in the mid-20s, versus if you look at the equipment business, it's in the low to mid-teens. And that's why their return on equity is growing as we speak, because they're going to a higher return business. I forgot to mention this. I mentioned their life insurance company earlier. I want to highlight this because this is very important. In that insurance company, they will invest in other people's storage businesses on a first mortgage basis. So I said that they typically carry 30% loan to value in debt on these properties. So what the life co of U-Haul will do is say, hey, Mr. or Mrs. Storage owner in Pig's Knuckle, Arkansas, we would like to provide you a first mortgage. But here's the catch. They have to provide them data about the property to provide that attractive rate. Now, think about it like this. If the storage unit, the owner is a poor owner, and for some reason they go to build it, it never gets going, it never gets cash flow positive, and they end up defaulting on that first mortgage, we have better information than anyone else already to be the buyer of that. And effectively what's happening is if the life co gets a default, the storage arm turns to the life co and says, we'll buy that and make your first mortgage whole. So it's a cost of financing to effectively grow storage through this old insurance appendage. And that's why I said it's kind of Berkshire Light. It's a cost of funds and also information that they gain on the marketplace for those transactions. Anything?
Okay.
Oh, yeah, I skipped over this. This is a good question. So it was U-Haul, U-H-A-L was the ticker. They don't have their head in the sand. They looked and said, we feel part of the reason why we're so cheap is that stock's not that liquid because you have a 54% owner. So what they did is they said, okay, for every voting share, U-Haul, we're going to spin out 9 shares of non-voting. So U-Haul is the voting, U-Haul B is the non-voting. I love the stock market because it does crazy things. In the first 2 to 3 weeks that they traded these two securities, the non-voting was trading at a premium to the voting. Now, do you really have a vote with the 54% owner? No, you don't. But it still was strange that they were giving the non-voting such a premium. It's now inverted. Yeah, the voting gets a premium, but again, your voting doesn't matter. Well, yeah, you get to vote your proxy and put a thumbs up and say, I voted. Oh, it's another good question. So they historically, they don't have a regular dividend. I despise regular dividends because once you announce a regular dividend, they're liabilities. You guys all with me on that? Once you announce a dividend, it's a liability. It's a payable on your balance sheet, waiting to be handed off. They only pay specials. Now, they're pretty regular, but they're specials. Why? Because these people are wicked smart. If they decide tomorrow, hey, you know what? We're in some weird environment and it's not a good time to pay a dividend. Let's go buy back stock. Let's go invest, etc. Great capital allocators. Absolutely great capital allocators. So I appreciate the question because it just shows you how advantageous they want to be in their capital structure.
What I'm saying is that the reason why somebody would choose to buy a non-dividend, a non-voting stock, is that there is no reason if you
You get no preferential dividend.
So why should I buy a B stock rather than A stock?
Because you pay less.
Because you pay less? Because
Yeah,
the price
your
is
non-voting is cheaper than the voting now. So now, by the way,
Yeah, but what matters is the price change, not the level. You know, obviously.
well, no. I want to buy the most economics per share I can get. Where can you get that as we speak? In the non-voting. Right? In other words, I'm paying a cheaper price for the same vote, for the same economic rights. Why would I pay slightly more for the same economic rights? Now, by the way, there was a time where you could buy the voting for cheaper value per economic rights. So this is not like Europe where they say, hey, you know, you lose your voting right because you own Volkswagen Prefs, so you get a little higher dividend. No, you don't get anything more. So just pay the cheaper price. Also, there's 9 times more shares. So if you had a client wake up tomorrow and say, hey, I got to liquidate because I'm buying my yacht, great. You can sell the non-voting a lot easier than you can sell the voting.
Why do you think such a big company doesn't have any analyst coverage? Is there corporate governance issues for splitting the voting, non-voting stock? I mean,
Yeah.
I would suggest that the reason there's no coverage is obviously there's corporate governance issues.
These guys would never talk to a banker if their life depended on it, and they've never had a reason to. Okay. If you look at if you looked at even like if I went back to their balance sheet, you'll see there's a lot of private placements where they're not even going to a banker to go out and place their debt. They're finding institutions on their own with their lawyers. So again, I just don't think the fees are there or the relationship is there historically speaking. That's why when they went to go do this non-voting voting, they said, hey, let's create more liquidity and maybe it'll attract the sell side, but they don't do any banking revenue. Okay. I think that's the real secret to them is because the investment bankers won't talk to them because they've never done any business with them. So